Imagine waking up one morning to learn that one of the richest, most data-driven minds on the planet has been quietly reducing his exposure to the very system that made him wealthy. He's not doing it with dramatic headlines or panic tweets, but with methodical, almost surgical moves that you'll only see if you know exactly where to look. This isn't about a celebrity cashing out for a luxury lifestyle, and it's not a conspiracy thriller. It's about signals, timing, and what happens when someone who built an empire on anticipating the future starts preparing for a very different one, while most of us are distracted by the daily noise of the market. For decades, Bill Gates has been a symbol of long-term optimism in capitalism and technology. Microsoft wasn't just a short-term trade, it was a generational bet on the future. But over the last several years, something subtle yet profound has been happening. Gates has been steadily reducing his direct exposure to traditional stocks. He's restructured his holdings through his investment firm, Cascade, and increased his allocation to hard assets, things like farmland, infrastructure, and cash-like instruments. He's also accelerated wealth transfers, moving assets off his personal balance sheet. And on the surface, it might look like simple diversification or philanthropy. But if you look deeper, it looks like risk management on a scale most investors can barely imagine. When a man with nearly $90 billion isn't chasing the hottest tech rallies or meme stocks, but is instead quietly moving into assets that protect purchasing power, it's worth asking one simple question. Why? To understand this warning, you have to zoom out beyond the headlines and quarterly earnings reports. Right now, markets are sitting on historically extreme valuations by almost every long-term metric. The Shiller-Cape ratio, which smooths out earnings over 10 years to account for market cycles, has spent long periods far above its historical average. This is a red zone that has previously only existed right before major market crashes, like in 1929, 2000, and the years leading up to 2008. At the same time, global debt has exploded. Governments, corporations, and households are carrying debt loads that would have been unthinkable just a few decades ago. Now, debt itself isn't necessarily evil, but when interest rates start to rise even a little bit, the cost of servicing that debt becomes a slow burn crisis, quietly draining productivity and growth from the entire system. Bill Gates has always been a numbers person. He doesn't react to fear. He responds to probabilities. And the probability math today is uncomfortable. For years, central banks suppressed interest rates, effectively pulling future growth into the present. This cheap money-inflated asset prices encouraged wild speculation and rewarded anyone who took on massive leverage. But when inflation finally surged, policymakers were forced to slam on the brakes, raising rates aggressively. That single shift changes the entire investment landscape. Assets that thrived on cheap capital are now facing immense pressure, while assets that preserve real value are starting to matter again. This is where Gates's moves begin to make perfect sense. Let's look at Farmland, one of his most talked about but least understood investments. Gates has become one of the largest private farmland owners in the United States. He's not doing this because he wants to be a farmer. He's doing it because farmland behaves very differently from stocks. It produces a real yield in the form of crops. It benefits from food inflation. You can't just print more of it or create it digitally. Historically, productive land has been one of the best ways to preserve wealth through wars, currency resets, and financial crises. When inflation rises, food prices tend to rise with it, which supports land values. And when markets crash, people still have to eat. Now, this isn't a flashy trade. It's a defensive position rooted in centuries of economic history. The same logic applies to his investments in infrastructure and utilities. These assets generate steady cash flows tied to essential services we all need, like energy, water, and transportation. They don't promise explosive overnight growth, but they offer something much more valuable in an uncertain world: resilience. Gates has consistently favored businesses and assets that solve unavoidable problems. In an era where market narratives seem to change every single week, that preference signals a deep caution about the volatility ahead. It's not that he believes capitalism is ending tomorrow. It's that he recognizes that economies move in cycles, and he is preparing for a period of stress before it becomes obvious to everyone else. Then there's his quiet shift away from concentrated tech exposure. While Gates still believes in innovation, he no longer needs to bet heavily on speculative growth. Mature investors with a deep awareness of history know that technological revolutions don't eliminate market cycles, they just ride them. Remember the dot-com crash? It happened during a real world-changing technological boom. The technology did change the world, but investors who bought in at extreme valuations still lost their fortunes. Gates lived through that period from the inside. He understands that innovation and market prices are two very different things. So, when the man who built his fortune on the future starts preparing for a storm, it might be time for the rest of us to check the weather. Thanks for watching, and if you found this insightful, make sure to follow for more. Another overlooked element is currency risk. When governments run persistent deficits and central banks expand their balance sheets, the long-term purchasing power of fiat currency erodes. This doesn't always show up immediately, but over time, it acts like a hidden tax on your savings. Large institutional investors hedge this risk by owning real assets, commodities, and productive land. While Gates doesn't publicly champion gold or silver the way some investors do, his broader strategy aligns with the same principle: protect real value. Precious metals, for example, have historically served as monetary insurance, not because they generate income, but because they hold purchasing power when trust in paper promises weakens. You don't buy insurance expecting disaster every day. You buy it because the cost of being unprotected is just too high. What makes this moment so interesting is the silence. There's no dramatic warning speech, no urgent call to exit markets. That's not how serious capital moves. Instead, these changes appear quietly in filings, foundation reports, and long-term allocation trends. Wealth is transferred into philanthropic vehicles, which reduces taxable exposure and personal balance sheet risk. Assets are positioned for decades, not quarters. From a distance, everything looks calm, but calm does not mean complacent. In financial history, the most dangerous periods are often the ones where risk feels completely normalized. Ask yourself a simple question. If you had access to the best data, the best economists, and the longest historical perspective money could buy, would you be aggressively chasing maximum returns right now, or quietly prioritizing preservation? Gates's answer seems pretty clear. He's not selling because he's afraid of markets tomorrow. He's adjusting because he understands how fragile systems become when they're stretched too far. Extreme inequality, geopolitical tension, supply chain fragility, and demographic shifts all compound financial risk. None of these guarantee a collapse, but together they raise the odds of serious turbulence. This is where the warning becomes relevant for everyday people like you and me. You don't need billions to learn from billionaire behavior. The lesson isn't to copy their exact assets. It's to understand their mindset. Long-term thinkers reduce their exposure when optimism is extreme and build buffers when complacency dominates. They diversify across asset classes that behave differently under stress. They respect inflation as a silent force and volatility as a feature, not a bug, of modern markets. Most importantly, they plan before the fear becomes obvious. Bill Gates isn't quietly selling everything because the world is ending. He's repositioning because cycles turn, debts compound, and financial history rhymes more often than people like to admit. The $89 billion warning isn't a countdown clock. It's a signal about priorities shifting from growth at all costs to resilience, sustainability, and real value. And that shift tells us more about the future than any viral headline ever could. It's crucial to understand that Gates's actions don't exist in isolation. They sit inside a much larger macroeconomic picture that most people only see in fragments. When capital at the very top starts prioritizing preservation over expansion, it usually reflects a belief that the easy gains are already behind us. This doesn't mean markets can't go higher in the short term, but it does suggest that the risk-to-reward balance has shifted in a way that favors caution. Historically, this kind of shift has appeared during late-cycle environments, moments when growth is still visible, but increasingly fragile, supported more by liquidity and confidence than by solid fundamentals. So what does this mean for you? It's a prompt to review your own strategy, to think about your long-term goals, and to consider if your portfolio is built for resilience, not just for growth. Thank you for watching. Don't forget to like and subscribe for more insights. Ever wondered what Bill Gates is really up to? It's not just about buying farmland. His moves are a clue, a single word that explains a massive shift happening in the global economy, one that most of us only ever see in bits and pieces. That word is preservation. And when the wealthiest people in the world switch from a mindset of aggressive growth to one of protecting what they have, it's a sign. It suggests they believe the era of easy money and quick profits is winding down. Now, this doesn't mean the stock market can't hit new highs tomorrow. What it does mean is that the balance between risk and reward has changed. The smart money is becoming more cautious. And looking back through history, this kind of behavior almost always pops up in what economists call a late cycle environment. That's when the economy still looks good on the surface, but its foundations are getting shaky, propped up more by confidence and cheap money than by real, solid fundamentals. Inflation is a huge piece of this puzzle. We hear about inflation rates going up or down, but we often miss the bigger picture. The damage is cumulative. When the price of groceries goes up, it rarely comes back down to where it was. It just stabilizes at a new, higher level. This means the purchasing power you've lost is gone for good. For someone managing billions of dollars, this isn't just an inconvenience, it's a direct attack on their wealth. Even a seemingly small 3% inflation rate will wipe out nearly a third of your money's value over a decade. In 20 years, it's even worse. This simple math explains why they're moving into assets that hold their value or grow with inflation. This is where a lot of people get Gates' strategy wrong. They look at investments like farmland, infrastructure, or private companies and think they're boring. But in the world of high finance, boring is often just another word for safe. Sure, you can't sell a farm or a bridge in 5 minutes like you can a stock. These assets are illiquid, but that illiquidity comes with a benefit, a premium. Investors get paid extra for tying up their money in something productive for the long haul. In a world obsessed with daily stock tickers and instant profits, these kinds of assets force a level of discipline. They stop you from panic selling based on market noise and instead connect your wealth to the real, physical world, not just fleeting investor sentiment. There's another warning hidden in all of this, and it has to do with productivity. For the last 20 years, despite all our amazing new technology, productivity growth in major economies has been surprisingly slow. It's a puzzle economists are still trying to solve. Why isn't all this innovation making us dramatically more efficient? One theory is that our economy has become so dependent on debt and financial engineering that it's siphoning off the gains that should be fueling widespread growth. When you have slowing productivity but rising debt, the whole system becomes fragile. It starts to depend on constant government help and central bank intervention just to stay stable. So, what does this all mean for you and me? It's a call to look beyond the daily headlines. It's a reminder that the principles the ultra-wealthy use to protect their fortunes, focusing on real value, understanding the long-term effects of inflation, and valuing tangible assets, are principles we can all learn from. It's not about copying every move, but about understanding the quiet signals the market is sending. The shift from expansion to preservation is a profound one, and paying attention to it might just be the smartest financial move you can make. Thanks for watching, and if you found this helpful, be sure to subscribe for more insights.